How to tell if a stock is cheap or expensive. When it comes to the stock purchase, the price is often first consideration. However, the price of a stock and its value are not the same thing. You can determine whether a stock's present price is inexpensive or costly by looking at its value. This might assist you in determining whether or not it is beneficial to invest in. Here are the top 10 tips on how to tell if a stock is cheap or inexpensive. Now let's get into it. Number 10, compare the growth rate to the PE ratio. A high growth firm's PE ratio is determined by its predictable market growth rate. The higher the expected growth rate, the higher the PE ratio. For example, the PE ratio, which was anticipated with 28.75 with a 25% growth rate, will alter as the expected growth rate changes. Divide the price of the share by earnings per share to get the price to earnings ratio of a stock option. Then compare it to the growth rate. The stock rate may be overvalued if the PE ratio is larger than the growth rate. Examine the growth rate by looking at how earnings have changed year over year. A higher PE ratio indicates that investors are willing to pay a higher share price now in anticipation of future growth. Investors expected the company to grow faster than the market as a whole, as evidenced by the high multiple. A high price-to-earnings ratio does not always have to imply the stock is overvalued. An investment can determine the true worth of a stock by comparing the two data points. Avoid stocks with a price-to-earning ratio that is lower than their typical growth rate. Number 9, consumer demand on Main Street is measurable. So how do you gauge stocks demand? To begin, look at the average daily trading volume. Keep an eye out for the days when the number of shares exchanged is much higher or lower than usual. Demand is indicated when the share price rises significantly and the trade volume spikes substantially above usual. In the end, a business can only be valued if it produces things and services that others desire. On Wall Street, companies that are seeing increased demands on Main Street will often see increased share values. Earning reports, same-store sale figures, and other data sources can help you to determine whether the company is likely to grow in the following 1 to 3 years. Number 8, compare PE ratios to competitors. A broad market analysis can provide a useful frame of reference for valuing specific stocks. Determine 3 competitors to your target stock that compete on a similar financial footing and compare their stock's price-to-earnings ratio, PE ratio, to the one you're investing. It's a positive sign your stock's PE ratio is much higher than the bulk of the relative competitors if it's overvalued. If a stock PE ratio is lower than most of its competitors, it may be undervalued and worth investing further. The average PE ratio of a similar competitor is a useful overall predictor of valuation, and it doesn't account for all the factors that can affect a stock's price, so it should be used in conjunction with additional research. Number 7, reputation of the stock. A company or stock's reputation can have a significant impact on its value. A stock that is recently purchased by a high-profile person, for example, may overvalue the market. Stocks that are receiving a lot of attention from industry-relevant media outlets and well-known investors can sell for an inflation price as a result of the hype. When determining the stock's genuine value, take into account its profile. Therefore, to avoid the lure of pricey stocks with a lot of publicity and invest your money with as much objectivity as possible. It's your own stock that becomes popular and may be a good time to sell. It may be a good time to sell and profit from the temporary overvaluation. Number 6, import sellers. Pay attention to people in positions of authority and expertise so you can react if they sell their stock. People in positions of power in a company are more likely to be aware of the overvaluations and will want to sell their shares as soon as feasible. So follow their lead as much as possible. Most directors and executives will not sell shares in a company in which they have complete faith. Therefore, if they do, it can be a trustworthy predictor of an organization's health. One person selling their stock is probably not a cause for alarm, but a large number of powerful people start selling, you should be concerned. Detecting symptoms of overvaluation can save investors a significant amount of money. Knowing when to purchase and sell is much easier when you have the right knowledge. So put in the time and effort to figure out the genuine value of any potential investments before you put your money down. While none of these strategies are fail-safe in one of itself, they can be extremely useful when combined with your basic research process. Number 5, use PEG. The price-to-earning ratio, PE ratio, is another prominent method for determining stock values. The PE ratio shows how much investors are willing to pay for each unit of earnings. This indicator is used by companies to determine whether a stock price is lower or greater than it's been in the past. It can also be used to compare the value of different firm stocks, different than the current stock price by the current earnings per share to get the PE ratio. If the stock price to earnings ratio is 50, investors are willing to pay $50 for every dollar of profit. Companies on the whole prefer to have lower PE ratios. The lower it is, the better the stock appears. The stock with a low price to earning ratio are less expensive to buy than those with a high price to earnings ratio. Some investors anticipate by purchasing these stocks at a reduced price, firms with a low PE ratio will recover. The investors will make a profit if this occurs. Number 4, price versus net present value, NPV. The most comprehensive method of evaluating for investment is price to NPV. To establish the net present value, a financial analysis will develop a financial model in Excel that forecasts the business's revenue, expenses, capital investment, and resulting cash flow in the future, NPV. The financial analyst will compare the value derivative from the discount cash flow, DCF, analyst to the asset market value. To understand more, download CFI's free financial modeling handbook. If the project only has one cash flow, you can use the following net present value formula to calculate NPV. NPV equals cash flow divided by 1 plus I, T minus initial investment. NPV, today's value of the expected cash flows, today's value of invested cash. ROI, total benefits minus total cost, divided by total cost. If the net present value NPV is positive, it signifies the income cash flow is greater than the expense cash flows. When faced with various investment options, the investor should always choose the option when it has the highest net present value NPV. This is only true if the highest NPV option is not negative. Number 3, short and long strategies. When a stock is overvalued, it provides a chance to sell shares short. When a stock is undervalued, it is a good time to buy its shares and go long. To pay under overvalued equities, hedge funds and accredited investors sometimes utilize a combination of short and long bets. Check out CFI's Technical Analysis Guide to learn more about trading. Both types of investment have advantages and disadvantages. Short-term investing allows you to reach your financial goals in a short period of time while minimizing risk. Long-term investment avenues, on the other hand, are suitable for investors with higher risk appetite and a desire for better returns. Fundamental investors should generally hold stocks for the long term, which means at least a few months and preferably many years. Holding stocks for a short period of time is more of akin to speculating than investing, and it increases your chances of losing money in the long run. Number 2, value versus growth investing. Investors that believe in value investing will not buy stocks that are worth more than their inherent value. Instead, they are solely interested in finding cheap stocks. A growth investor is the polar opposite of the value investor, believing that the stock is not overpriced and will generate more growth than the market, i.e. other investors expect. Number 1, enterprise value to revenue. The value to revenue ratio is one of the financial performance indicators for a stock, especially when they compare it to their companies in the same industry. This measure, also known as the enterprise value to revenue ratio, compares a company's annual revenue to its total worth, which includes assets and debts. A smaller ratio, in general, indicates that the company is generating a decent return on each dollar invested. The return on investment ratio is in the inverse of this ratio. The enterprise value of revenue, EVR, ratio can be quickly compounded by dividing the company's enterprise. The enterprise value to revenue, EVR, ratio can be quickly computed by dividing the company's enterprise value by its revenue. A price to sales, PS ratio, of 1 of 2 is considered decent, while 1 is less considered exceptional. What crypto-related topics do you want to talk about next? Let us know in the comment section below. Thanks for watching. See you in the next video.